Yeah. Surprise, a little different than you're used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck.
Hey, what's going on? Welcome to this evening's live stream. You've seen the titles of this stream. I want to talk about the intervention that the FCA has now brought into force to basically force the banks to pass on the interest rate hikes, which we saw another one of today, to savers. So I'm going to be going through. It's a 14-point action plan, essentially, that the FCA has brought up. This may be a little boring, guys. I'm sorry. But the plan here is to kind of give you the gist of what's going on. And just, I've asked the question in the poll as well. Do you think this is going to be effective? I've said over the past couple of streams, I'm a bit of a pessimist when it comes to this kind of stuff because I like to prepare for the worst, hope for the best. In this situation, the points are all very good. And I think the action plan is well-intentioned. But as always, and I've been around in the industry to know this, it's all about how this is interpreted by the banks and how much of it is going to be enforced by the FCA being the regulator who's come up with this action plan, right? So it's going to be extremely interesting. And actually, there are some data points behind all of this as well, which kind of puts you in a conundrum if you're a saver. And one of the reasons why we need more competition in the space. But anyway, we'll go through the entire thing. And again, I want to get your views, your opinions, because again, it's not just about me and what I think, it's also about what you think as well. So if you've missed the news today, or maybe you weren't tuned into the live that we had this afternoon, the Bank of England base rate went up again today for the 14th time to 5.25%. So we saw a 0.25% increase. People were hoping there was going to be a 0.5% increase. I was personally hoping for there to be a 0.5% increase just to really make sure that we were able to, really put the pressure on inflation and hopefully bring that 2% target forward from Q2 2024 when we're likely to hit it to maybe even Q1, Q4 this year. But it feels as though the wisdom that is in the Monetary Policy Committee have decided to go with a 0.25% increase. Interestingly, a couple of members did vote for a 0.5% increase, but obviously it's based on a democracy there. They go with the majority rule. So 0.25 it was. Now, obviously, I've spoken a lot about the fact that this will have negative consequences for mortgage holders and for renters because it's going to get passed along. But one thing it is going to do, which is a positive, it's going to be good for savers. And for savers specifically, if you're unlucky to have been in a position where you've had cash sat around and you're not getting a lot of interest, it feels like your money's not working as hard for you. The good news is that the rates have gone up, but they haven't gone up as much as they should have. And this is going to be the first port or thing that I'm going to share with you, because the numbers behind this are actually very, very interesting. So just take a look at this really quickly. So this is an article with The Independent. So 250 billion, that's a quarter of a trillion, sits in accounts earning no interest as regulator tackles poor rates for savers. All right. Now, just check this out, right? So the intention around here is, around 250 billion is sitting in accounts that are no interest. A regulator warned on Monday as it launched a plan to ensure banks are passing on interest rate rises to savers. The Financial Conduct Authority said its cash savings market review shows Britain needs to build more consumer financial resilience. I often talk about the fact that, 1 in 4 of us in the UK have less than £100 in savings. 1 in 3 of us have zero savings. And the podcast this week was all about improving your saving skills. And people like Wealthify are producing and developing products that are designed to help us do that from a habitual point of view. So really, really interesting. 3 in 10 adults don't have savings at all, it's found. Now, here's the real thing. 3/4, so 75% of consumers who do have savings use the same bank as their main current account, the FCA has found. But for easy access accounts, in which 60% of balances across 9 of the largest firms are held. The average interest rate has risen from 0.07% to 1.25% between January 2022 and May 2023. Now, we started, let me just come full screen here. We started raising interest rates all the way back in December of 2021. So between then and now, we have seen what, a 0.15% increase in the average interest rate that is being offered by savings accounts. And during that period of time, I mean, if we go back to May, actually, I need to bring up another screen here because I can check this live with you. Let's see where the interest rate was as of May this year. Where were we when it came to the interest rates? Let me have a look quickly, and I'll show you this screen once I've got it up and running, so that you can kind of draw some comparison here. So we're looking at May 23. Let me share this, and let's go here. All right, so this is the interest rate curve. We've looked at this a number of times before. So May 23. Actually, we need to go in. Let's go in a year. So around about May, which will be here, we were at what? 4.25%. So the bank rate had increased quite significantly from, even if we call it from 0.5% to 4.25%. So that's a 3.75% increase. And only about 1.15 of that was actually passed on to consumers in their savings account. So clearly you can see, and it kind of backs up with this piece of data from the FCA right here. And this is why they're doing this, right? So it says 9 of the biggest savings providers on average only pass through 28% of the base rate rise to their easy access deposits between January 22 and May 2023. Notice and fixed term deposits have seen greater pass through of rates, with these 9 firms passing through 51% over the same period. Now, at that juncture, I think it's really important to kind of talk about the difference between easy access and notice accounts. So easy access is instant access. You can get hold of it immediately. You know, you haven't got to give any notice. Whereas a notice is exactly that. You need to give them notice to access your funds. And the reason why that they often offer a higher rate is because obviously fractional banking, you're putting in £1, they're lending it out 4 times, and they just want notice to say, look, I need my money within 90 days. It allows them to raise the funds to give you back your money, make your cash available, right? So therefore, they're incentivized to give you a little bit more of an interest rate rise or an attractive interest rate, because you're giving them notice. You're giving them that knowing in the future of, we need to make X amount available within 90 days for this group of customers, right? Whereas with an instant access, they can't really do that. Yes, they're going to lend your money out, where they might lend it out 4 times, you know, for every £1, they might only be able to do it twice. So they're not able to utilize your money as much. The beauty of fractional banking. So it goes to reason that normally instant access accounts will often attract less interest than things like notice accounts or even fixed term accounts, where, you know, you're fixing it in for a year. So they know, like, we're going to get £10,000 from Smithy here, and for that £10,000, we can turn that into £40,000 worth of lending, earning us X amount of money, and they give you a proportion of that, albeit a small proportion of it. So that's the reason why, you know, we see differing rates in interest rates here. There was an interesting point in this article as well, which I think is also just worthwhile just bearing in mind. So let me just share this one again. It says here, according to figures released by Moneyfacts Compare.uk, the average 2 years, so they're comparing here, you know, the difference between mortgage rates here and typical savings rates. So the average mortgage, 2-year fixed rate mortgage for a homeowner on the market is around about 6.81 at the moment. Pretty high, right? We'll talk maybe tomorrow about whether we're going to see interest rates move as of the result for the Bank of England increase in bank rates today. We'll do that tomorrow. While the average easy access savings account is about 2.78%, and the typical 1-year fix, so locking it in for 12 months, is at 5.19%. Now, the disparity between the two is actually quite large, but actually, if you're in a position where you could lock your money away for 1 year, 5.19% is a pretty attractive rate. But as we've already established, they haven't really passed on huge amounts of their savings. It also says here, firms offering the lowest rate. So this is part of the mechanisms, the guidelines, the action plan that the FCA is coming in. Actually, let's just go through it right now. It's a 14-point. We may go through all 14. If not, I'll pick up the most salient ones, right? So this is what the plan is basically saying. So it requires firms offering the lowest rates to provide their fair value assessments under the consumer duty by the 31st of August, which is this month, and take robust action by the end of 2023 against those who cannot demonstrate their value. So if there are any banks out there that can't demonstrate how they're providing fair value to their savers, the FCA is basically saying they're going to take action against them. Point number 2, review the timings of firms' savings rate changes each time there is a base rate change. Now, I don't know about you, but for me, this one is a little annoying. And I'll tell you why. Because if you've been paying attention to the news, it feels as though we're at the end of the interest rate hike cycle. We've probably got another 2 if all things go to plan. Now, we all know over the last 18 months, they've been extremely slow passing on these rates. So if this is something that they're implementing from like Monday this week, and they need to demonstrate this by the end of August, my question is, are they going to go back retrospectively and examine, well, during, May 23 and July 23, there was this Bank of England interest rate hike, and you took, 40 days, 60 days, or whatever it might be to pass on this increase to your savers, or you did nothing at all. What's going to happen then? So it's all very well and so that they have to prove how quickly they were able to implement and pass on these interest rates. But are they going to go back retrospectively? Because I would love to see what happens if they did so. And if we are at the end of this interest rate cycle, this point number 2, it feels a little, so what type thing, right? I don't know if you agree. Let me know if you do in the comments right here. It says here, publish an analysis every 6 months of firms' easy access savings rate, listing distribution from best to worst. I think this will be effective purely because I don't think there will be any banks or providers out there who would want to be in the worst category. So this is pretty much naming and shaming. And I like that they're targeting easy access savings rates specifically. But then again, let me just go back here very, very quickly. Because as it alluded to here, that most of this 250 billion is sat with the 9 largest banks. Now, this is where it becomes problematic and where we potentially need more competition in the financial services and the banking space, right? Because if everyone's got their money with the biggest 9 providers, those are the big players. So if they don't increase their rates, or they get into cahoots to keep their rates low, where's the money going to move to? Because when you think about age demographics, right, it's all very well and good for younger people who are up with tech to explore using banks like Starling, for example, or Monzo, or anyone else that doesn't have a physical branch where you're accessing the service via your phone. It's good for younger people, but for older people, that isn't necessarily going to be appropriate. It's not going to be the right thing. And many people will argue that actually a bulk of the wealth is going to be with the baby boomers who are probably retiring right now, and they may not necessarily be comfortable with technology. So there needs to be concerted effort to make sure that the top 9 banks don't get into cahoots and don't agree amongst themselves under a gentleman's agreement to keep the rates of their easy access accounts artificially low, because, well, guess what? There's nowhere for anyone to go to besides looking outside the top 9. And I think that's going to be a real issue for the FCA. And I would love to know how they're going to go about actually tackling that meaningfully moving forward. Let's get back to the guidelines right here. So that was number 3. They're going to say they're going to analyze the difference between on-sale and off-sale products. So I think this is where they might be running introductory offers, maybe where they have a sale on for a certain period of time, challenging firms to explain how large differences offer fair value and considering further action if these gaps do not continue to close. And I think that maybe is around about creating a little bit more competition amongst the big 9 and maybe some of the bigger players within the space. Review firms' performance on cash to cash switching. This is cash ISA to cash ISA switching. This right here is actually an important, very, very important point. Purely because if you've been following the channel, you'll know that your cash ISAs, you get £20,000 allowance every single year. A lot of people will dump money into their cash ISAs because it's tax free, right? So, from a logical point of view, if you're thinking about it from a financial lens, tax efficiency first. You would always put your money into your ISAs because effectively you're not paying tax on those. And there's a lot of money sat in cash ISAs here in the UK. So them actually looking at, the performance on the cash ISA switches, I think is going to be really, really important because if you're able to get a really good, easy access, instant account, which is a cash ISA, typically they have 30 days to do a switch. Typically, if they're taking 40, 45 days, then that's going to be detrimental to you, the saver. And you may not necessarily be compensated for that additional 15 or 10 days that they took. So making sure that that switching process is as smooth as it can be is really, really important because the ISA account itself is going to be one of the key things that people will end up using. Conduct further analysis into the contribution of cash savings to firms' profitability. So, I don't know how. I think it will be effective, but I have some reservations about that. How much does cash savings actually contribute to a bank's profitability? I don't know the numbers on that specifically. It will be interesting to see them. They're saying here that we'll review the effectiveness of firms' engagement with customers by the end of March 2024 and take action if firms have not effectively delivered the outcomes the FCA have set out. What's going to be the outcome if they find that companies have not been communicating, they've not been engaging with their customers in the most appropriate way possible to let them know what the best offers out there are in order for them to take advantage of these savings rates increasing, right? What are they going to do? And my worst fear is that they'll just, they'll give a few £100,000 in fines when really for this kind of stuff to really hit home, you need big fines or you need big consequences, really, because otherwise they'll do a risk reward analysis and be like, yeah, I think we can foot the bill for this if we do this, because the analysis they will do is if we don't do this and we do this as an alternative, what's our profitability? Well, if the fine is going to be something like this, we could afford to pay it because actually we're still making profit. That's a very cynical way of thinking, but I think it's also naive to think that they don't think like that in the boardroom as well. They'll be looking at all contingencies, even from a legal point of view as well. They'll be looking at all things. What they're saying here is work with others, including the money and pension service, to identify what more can be done to support consumers to save regularly, strengthening their financial resilience. This right here is going to be a really, really big one. I spoke about this a little bit earlier on today and on the live last night. Interest rates is going to impact. It will impact everyone. If you're renting, it's impacting you. If you have a mortgage, it's going to impact you unless you're locked into a fixed rate for the next 2-3 years. You got a really good deal. Like someone said, they locked into a rate of, I think it's 1.49 for a 5-year term at the end of 2021. I mean, how about timing things? That's perfect timing, right? Unless you're one of those people, you are going to be affected by this. And the reality is, and we've already spoken about, 1 in 4 people have less than £100 in savings. 1 in 3 of us have zero savings at all. And when you think about what we can do to control our own personal finances, how can we improve our saving skills? How can we improve our financial resilience? It's not just about the practical application. I have to keep banging on about this because I've lived through it and I understand through my own experiences that everyone knows that they need to save money, that they should have an emergency fund. But the practicalities of actually doing it, even when you know what to do, you're fighting your own internal habit, your own behavioral patterns. And that's what you need to break. The minute you can break that, the practical elements start to come into it. And it's such a difficult thing to do. And you may think it's easy because it's almost like a light bulb goes off in your head, but it takes some doing for the light bulb to really go off. And I've been doing a lot of talks recently where I'm just encouraging people to really explore what those behavioral patterns are around, particularly your spending habits. Because for a lot of people, well, let me speak for myself. For me, one of the reasons why I always failed to put money aside in an emergency fund for so long was because my spending habits were just so messed up. I was caught I didn't have a train of thought. I didn't really have any thinking, any logical, practical thinking about, right, I've got this much coming in. I'm going to put money here, here, and here. I never had that train of thought. Money came in. As long as I paid my bills, the rest was just fun money. It's the wrong way to look at things. And to turn that clog off, to form a new habit, a new way of thinking takes a little bit of effort. And one of the things that I have been doing is I've been working on behavioral assessments, looking at those. There are some pinned in the comment section as well. There's one in particular around spending habits, which I would encourage anyone to take. It's very, very, very eye-opening in terms of whether your spending habits are triggered by certain things. And this is an exercise that I had to go through myself. And the exercise that I went through kind of bore out the spending habits assessment that I have in the bio of this video. But at the end of it, you'll get a result, you'll get a score, you'll get a result, and you'll get some practical tips to actually help you. But I'd encourage everyone to really have a look at that, because it's going to be a really big point moving forward as we try and acclimatize to what the new norms are going to be. And unfortunately, the new norms are higher rents, higher mortgage payments, and most things being more expensive. We already know that energy prices, even though the wholesale prices are coming down, energy prices are still pretty much where they were. I think I've seen my energy bill fall by about £120 for the year. I'm still paying significantly more than I was paying 2 years ago. And I'm sure that you are as well watching this. So we need to acclimatize. And part of this is really understanding what our personal triggers are that prevent us from taking charge of our own personal finances. Let's get back to these, because there are some things that the firms or some things that the FCA expects firms to basically do. And I just want to share that before we get into what your thoughts are and your commentary. And we get into the comment section. So, right. So FCA expects firms to do the following. So from today, this is as of Monday, use their fair value assessments of on-sale savings products to assure themselves and the FCA, where needed, that these represent fair value for their customers. I would love to see their fair value assessment. I tried to find it. I could not find it, because I'd love to know what they expect the banks to do. Accelerate their fair value assessments for off-sale accounts ahead of the July 2024 consumer duty deadline for off-sale accounts. That gives them quite a long time. So hopefully none of them miss it. They all keep to it. Take action to prompt their customers in lower pay and savings accounts or non-interest bearing accounts to consider alternatives. So this kind of connects a little bit more with the communication, right? What are they going to do to contact customers? I mean, it's going to be an email. It's going to be a letter, if people are still opted in for letters. I don't know about you, but I get emails all the time. And I look at who sent it. I scan the first line. And if it's not something that grabs my attention, I delete it. And that isn't going to be their problem at all. But I think that in the age of social media, I hope that the banks actually put some money behind social media campaigns, talking about interest rates, talking about what they have to offer, in opposed to just sending an email or a letter. Because I think that will go into the junk folder of a lot of people who are probably like me, who just scan things and then just don't even bother reading through it. Number 12, closely monitor the effectiveness of customer communications with larger firms providing the FCA with an evaluation by the end of 2023 and any follow-up action they are taking. I think that's going to be following on from that. Just evidence, really. Support consumer financial resilience by encouraging customers to start saving and or search for higher rates, with the largest firms committing to support a targeted firm-by-firm communications campaign. Now, they're saying campaign here, and look, I'm all for this. Anything to help improve savings habits, saving skills, I'm well up for it. People like Wealthify are already well ahead of the curve here. And I hope that the big 9 banks or some of the larger providers out there in the savings space who are offering rates and offering accounts actually do something tangible, like really do something tangible from an educational point of view. There are so many things they could do here, so many things. And I'm hoping that I'm sure, I say this, I'm sure their marketing departments will jump at the opportunity of doing something a little bit different and engage in a different way. The last one here, consider how they can support their customers to access the free advice available from Money Helper. Money Helper, I can't say I've used the service or know of the service. Look, anything that will help people make better decisions, I think is always going to be a good thing. I just question how many people would be willing to sit on maybe a phone call and wait all the time. And that's why channels like mine, I guess, do really, really well, because we can have these kind of conversations in real time. But that's what the FCA is basically doing. The poll I asked earlier on basically asked whether or not you felt this would be effective. Let me just end this poll right now and see what everyone's saying. So the results are that 58% of you who have voted, and thank you for voting, by the way, think that this will not be effective, while 41% of you think it will be effective. I'll say this. Because it's the regulator who's coming up with this, I think the banks will definitely sit up and listen and pay attention. My reservation around this is twofold. Number one, how would the banks interpret these? And how does that interpretation then impact what they actually do? And crucially, number two, if they don't do what is expected of them, what are the consequences? Because if the FCA doesn't enforce it and doesn't demonstrate that they're willing to enforce it, the banks may not do it. They just may not do it. And I sincerely hope that if the banks don't pass on these interest rate hikes to benefit savers, that there are real meaningful consequences for the banks. That's my sincere hope, but who knows? Anyway, let's see what you guys are saying. That's enough of my monologue. Let's see what you guys are saying. So let me just make this a little bit bigger because I can't even actually see that. My eyesight's so bad. With most people having next to nothing in savings, I don't really think it will hurt the banks, although it may encourage investors to just slam money in the bank instead of into property. That is very, very true. I mean, look, one of the things that you need to consider is whether you're looking at property or whether you're looking at investing, like the stock market per se, right? Those two things have risk. Now, let me speak about the stock market because I know more about the stock market than I do the property market, right? When you're investing in the stock market, obviously the risk is you can put your money in today and volatility could mean that you lose 10%, 5%, 2% within a matter of days, right? Or within a matter of months or so. There's always a risk of loss. Now, in times like this where you see high interest rates, from a consumer point of view, the natural question to ask is, well, hang on a second. Why should I go and put £10,000 into the stock market where I might have a little bit of a risk of losing some money when I know that I can get a 1-year fixed rate of 5.19%? And for those people who aren't quite ready to invest or don't quite understand how to mitigate that risk, right, with their investments. So understanding the timelines, understanding asset allocation and how to actually build a portfolio, where to invest, diversification, so on and so forth, right? They may just say, oh, sod it. 5.19 is good enough for me. I'm not going to bother with the markets, particularly when, the markets may be struggling, right? Particularly when the markets may be struggling and, you might not be getting, your 3% return or even a 5% return at this point in time because of volatility. So savings becomes more attractive in that instance, and more people will flock to savings accounts rather than investing. And that obviously can have a negative impact on the stock market specifically. And that in itself can be quite compounding, because once you get almost the first wave of people who realize, oh, rates are really good. I mean, if you get to 6% fixed rate, 7% fixed rates, you're seriously considering whether or not you should be investing, especially on the short-term timeframes, right? Long-term, no brainer. Invest. The markets return pretty well over the longer term. But for people who need money within 2, 3, 4 years, fixed rates become even more attractive than investing in the market. And you know what I say? You should never invest in the market if you're investing for less than 5 years. The risk is simply too high. But high interest rates will definitely feed into that equation for a lot of people who may be sitting on cash right now thinking, I wonder where I should go, save or invest. Meji, how you doing? Welcome. Thanks for joining. Let's have a look at this. Oh, by the way, guys. Okay, let me just ask you a favor, okay? I do this on every live, and I don't know if I did this at the beginning. I've completely forgot. I don't think I did. Look, if you're getting value from this video, please consider tapping that like button. The reason for it is that, there may be people who may need to hear this conversation and may benefit from what we're talking about right now. It may inform them to maybe hold fire, hunt around, search around for the best savings rate available. And by you tapping the like button, it tells the YouTube algorithm that you got better value from this and you actually enjoyed it. And it will mean that the YouTube algorithm will suggest this to other people who may be searching YouTube right now for, savings rate, how to get the best out of my savings and cash. It just means that the algorithm is going to suggest it to them. So if you can smash the like button, that will be very much appreciated. We're at 22 right now. If we can get it to about 30, 35, that will be absolutely amazing. So Zero Head is saying here, Chase seem to be the only bank that are doing a solid with their instant access, going up to 4.1% on the 14th. I haven't covered Chase, but Chase are very, very good. See, this is the thing, right? So a lot of banks, they have the ability to run like loss leader accounts. Typically, that account with Chase will be a loss leader. They're not going to make any money with it, but essentially what they're able to do is if they're able to get you in with instant access, current accounts, that kind of stuff, you're more likely going to use them for things like credit cards, which is where they really then start to make money. So it will be interesting to see how the product set of these banks now looks with this. But Chase are doing a really, really good job. I'm sure they had like a 5% cashback account. I'm pretty sure they did a while back. Maybe I'll do a video on that at some point. But yeah, Chase is one of the good ones. Another good one is Chip. Chip has got a really good account, and they are very, very quick to pass on the interest rate hikes to customers. But Chip is very much a new incumbent. It's not one of the big nine, right? And this is, again, what I talked about at the beginning of this. We need new incumbents, new entrants into the market to give the big nine who are housing and holding on to 250 billion quid a run for their money. And just awareness is important. Awareness will play a big part to that. Let's have a look at this one. I noticed last month quite a few accounts raised their rates, pricing in this and possibly the next rise. Honestly, though, the only reason why the main banks increased their rates from a pittance to what is now due to the challenger banks, not the FCA. I would agree with that. I think when you think of companies like Chip and some others that are out there at the moment, they're getting nervous. But here's my honest belief, or at least my hope. And bearing in mind, I work for a lot of the big banks. I've worked for Nationwide. I've worked for NatWest, Royal Bank of Scotland. They're losing ground. I feel like they're losing touch with the new age of customer that's out there. I don't necessarily feel as though they understand the marketplace. There's probably one that I know that I've done a bit of work with that they've surprised me. I mean, their approach has changed like massively. Halifax. I mean, the stuff that they're doing in terms of having better conversations with customers is pretty amazing. I didn't know this until I met a guy called Rack, who runs one of the branches in London. He's amazing, and the stuff that they're doing is insane. And I hope that the rest of them do something similar to this. But this is where I think that the new challenger banks, it's so much easier to do business with them because they're using technology, and that's great for people like me and people of my age and people who are tech savvy. But again, for the older customer base, it may not be the best solution for them. And so I think challenger banks will always be an important part, not just to provide competition for the big banks and the big providers right now, but to actually push the sector forward in terms of innovation, in terms of new things that we can do, thinking outside of the box. I think they have a crucial role to play there. And my fear is that the big banks are too far behind to be able to compete or catch up. But because they've got their size and scale and they've got the legacy of being around for such a long time, they still have that. And I don't know whether I can say this word, trust. It's a funny one, right? Banks, trust. But they still have that brand trust, I would say, is probably the right phrase, in terms of safety, financial services compensation scheme, which all of the small new incumbents do anyway. But it just feels like it means so much more when you're with a large bank that's been around for ages, that has the legacy. Who knows what's going to happen? Someone's saying here, the rate the big banks are closing down branches, they must be saving a fortune. Barclays, Lloyd, HSBC, Virgin have all left our local high streets for the past 1 to 2 years. 100%. I mean, look, the question is, have they replaced it with technology? And this is probably where they would argue. They would argue that they probably developed technology, which meant that there was a huge outlay out the front in preparation for those branch closures, because I think the writing has been on the wall for a very long time. I cannot tell you the last time I walked into a bank branch in the last 10 years. Probably 3 times, 4 times. There's no need to go into a branch anymore. And very much when you look at the way they're set up to do business now, and this is the one thing that does infuriate me, try and getting hold of any of these banks on the phone. I mean, I'm with Starling for my day-to-day business, so easy to get hold of. But you try getting hold of Barclays or any of the big ones, oh my God, what a palaver. It's an absolute ball ache. It's a nightmare. So that initial investment, maybe for technology perhaps, saves them a little bit of money. But have they also invested in telephone stuff? Are they invested in other infrastructures, internet, app-based stuff that would deliver things? There's no doubt that it's gonna save them money in the long run, as long as they're able to keep their costs down for the technology drive. But who knows? It will be interesting to see. But I think that the shape of the high street it's changed, and it's not going to go back. I mean, more and more closes. I think they'll just have satellite branches for people who physically have to go in. But most of the time, you're interacting via the phone, via apps, via chatbots, and stuff, really. So, yeah. Leandro, what's going on? Congrats on 42,000 subs. Thank you very much. Yes, we have actually increased that number, and thank you guys again. I said it this afternoon, but thank you very much, seriously, because when we did the live yesterday, I think we were like 10 short of 42,000, and right now, let me just refresh. Right now, we are at. Where are we at? We're at 42,000. I think it was like 29 at this point in time. So, really good rate. And thank you everyone who's, subscribed and shown a vote of confidence in the channel. It does mean a lot. It's a small gesture, but it does mean a lot. Thank you. What else you said here? Does the FCA need to see a 14x interest rate increase to act? Mate, I don't know. I would hope that they don't need to see a 14x. I mean, I think that, and again, I don't know because I don't work internally with them, but there may be some minimum expectations, possibly. I don't know. But it's a good question, what do they expect to see? Do they have minimum expectations? Because if they do, and they clearly articulate that, at least they're putting a marker in the sand to say, look, this is what we expect, and you have to adhere to this. That will force banks to move more than anything else. At least incentivize them with a stick to move. They could create a product for those of us who don't have property and save for a deposit. That won't affect the banks and could have a long-term customer. Yeah, I mean, some would argue that's what the lifetime ISAs are for, although a lot of the banks don't necessarily offer those to my knowledge at the moment. I can't think of a big mainstream bank that has a lifetime ISA. I may be wrong, but nothing comes to mind currently. But you'll be right. It could be a really attractive proposition for people who want to save for their first time for their deposit for their first home. That could be a really good market. Someone's just saying here, disappointed by Zupa 4.28 and Marcus 4.3 savings rate increases today. Are they instant access? Look, I would say if they're instant access, those are pretty good rates for instant access, but I don't know what rates they are and what kind of account they are. So if you find an instant access, easy access account of 4.28, mate, I'm taking someone's hand off for that. I don't know about you, but I am. Because on instant access, that's pretty good. That's a decent rate, but it could be a fixed rate. Even if it's a fixed rate, that's still pretty good, no? Don't you think? Considering where everywhere else everyone is at the moment, right? And again, I might do another video where we talk about interest rates and go through some of the top options out there. But is that bad? I feel like that's still pretty good. If we're looking at fixed rates, so a 1 year fixed rate of 5.19 for a year, if that's an instant access or a notice account, that's pretty good, I think. I don't know. Let me know. What do you guys think in the comments? Is that a good rate? 4.28, 4.3. Is that a good rate, or am I seeing things differently? Quarter people less than 100 quid. Don't think they're far off from the CBDC rollout as it becomes less of a hard sell to a good chunk of the population. Yes, I'd agree with that. I would agree with that. I'd love to know what that will look like really in practice. There are so many unanswered questions, and trying to find someone who actually can confidently speak about CBDCs. I haven't found one just yet. I would love to have someone on the show just to kind of like educate me on what that looks like practically, how it plugs into the system. Like, and I'm talking the financial system and the economy, really. How does that plug in? How does it interface? What are the consequences of that? And how does it actually work from a practical point of view? How do you use things like interest rates? Because there will have to be some nuanced change of some kind. I'm sure there has to be. And can we really roll one out without the partnership or the accordance of other European countries? Because you're no longer dealing in fiat currency at that point. So surely, what does that do to trade? There are so many questions I have, mate. So many questions. I'd love to speak to someone about it. If you guys know anyone that's on YouTube right now that you think might be really, really good for live, then please, please, please suggest in the comment section, because that is a topic that I would love someone to educate me on, because I'm not an expert in that space. First Direct still have good customer service. To be fair, First Direct have always been quite good. I don't know. Look, this is my experience of First Direct. My experience of First Direct is they've always gone after the kind of like the top tier of clients almost. I never was able to qualify for a First Direct account, and admittedly, my credit score was shocking. I was not in a good place financially. I've not tried since, to be fair, but I always had this experience of, like, it's hard to get an account with them. Like their checks were so much more robust. But I always heard that once you were in, because they go for the top tier clients, that their customer service was so much better than just normal banks. So we're saying that online tech and telephone banking doesn't steal my 80-plus-year-old parents. We're looking to switch to banking the local post office now. Mate, it's true. You know, if you have elderly members of your family, like app on the phone, no, the way they did business was going into the branch, handing over their passbook and having that updated. That's what they were used to. It's a big shift from going from that to everything's on your phone. It's big shift, big shift. CBDCs equal, there'll be negative interest rates and expiring currencies, so spend it or lose it, basically. I don't know, mate. Again, this is something I'd love to be educated on. I think with CBDCs, there's a lot of negative speculation around it. But I think in order to really kind of like draw an opinion, you need both sides. What's the good that's going to come with it? That's not to mean that we need to discount the bad, because people are very, very concerned about the fact that, you know, in the Bank of England paper, or whatever paper it was, talking about the fact that it will be programmable. That scares the living bejesus out of a lot of people, right? And it would scare me as well. But, you know, whilst we're trying to have confidence that our government would never knowingly or willingly restrict freedoms, you just don't know. You don't know. The world is changing at a rapid pace. You don't know what these guys would do. And all it takes is someone who just sees things in a completely different way to be like, no, that's it. We're doing it this way now. And then all of a sudden you're scuppered. I would love to know the good and the bad to be able to make a really rounded view of it. But who knows? You know, who knows? Type Q in the chatbot. That will take you to an agent to skip all the automated Q&As. I don't know what you're talking about there, mate. Automated Q&As. Anyway, that's the end of the questions and the comments that we have in here. Thank you so much for joining me for this. I will continue to have a look at what's going on with mortgage rates. There hasn't been a lot that's been out. I came across the minutes from the Bank of England a little bit earlier on this afternoon. I didn't want to rush and do a video specifically talking about some of the commentary that they had in the minutes or the summary to the meeting in this live, but we may do that tomorrow. But I think there's a few things that I've just noted just in terms of this conversation around maybe have a look at what's going on with savings rate right now, some of the best deals out there. We'll also have a look at what's going to happen with mortgage rates. That's probably going to be the next one for tomorrow. What's happening with mortgage rates. We may not see mortgage rates move, and that could be expected because it's likely that they priced in their hikes under the assumption that we were going to hit the 6% mark as the ceiling for interest rates. That's no longer the case. Most of the forecast now is 5.75. So if that is the case and they did previously price it in, then we shouldn't see mortgages move. However, if you're on a standard variable rate, and that right now is a bloodbath. It is an absolute bloodbath out there for standard variable rates right now. If you're on a tracker or any kind of variable rate, it's painful. Painful. So we'll cover that probably in a live tomorrow. We'll talk about maybe some things that people can do and go from there. But I appreciate you for joining me. Thank you so much. Whatever you're doing this evening, make sure that you take some time, enjoy it. And I will catch you tomorrow.
Yeah, surprise, a little different than you're used to. Yeah. Dropping these bars on YouTube, knowledge I introduce you. Yeah. We chasing this money like it's the prize, it's the voodoo. Fugazi, fugazi, it's just a lie we buying into. We need some cars on deck. Get the rollies, get the Moe, all the Mars on deck. We got the traders, got the picture with the Bentley in Dubai. Are you dripping in designer looking fly? On the bombardier, sipping on the wine. Broke man, we broke. Where's the fun in being broke? Stocks and bonds get you yo. That's what I'm teaching these folks. I see that smoke, see them choke. Getting coked while I'm researching these stocks. Buying coke. 20 months on the channel, million people taking note. I got a warrant for Buffet. I'm coming.